All right,
Recording started.
great, thank you. Looks like we're live. So people are just joining. Wait just another moment. All right, it looks like everyone's in or they're joining now. So thanks to everyone for joining. Good afternoon. My name is Natalie Wolf. I'm the Director of Investments at Foundation for the Carolinas. And on behalf of the executive leadership team at Foundation for the Carolinas, we thank you for joining us today. If at any time during the webinar you have questions or would like further clarification on a specific topic, invite you to post the questions in the Q&A box. You'll see it on the bottom of your screen, and just press Q&A and you can type in a question. The Mercer team will address these after the presentation during the Q&A portion of the webinar. And if we do not get to your question during the session, we will follow up with you after the webinar. This webinar is being recorded, and the link will be added to the fftc.org website, and you can access it by going to the menu, and the link is under Engage. If you scroll down a little bit, it's under Events and Webinars. I will now introduce Travis Pruitt, who is our lead consulting relationship at Mercer. Travis will be leading the discussion and address market conditions and the investment performance for Foundation for the Carolinas investment pools during the third quarter of 2023 and really year to date. So thanks, Travis. I'll hand it over to you.
Perfect. Thanks, Natalie. Well, thanks everyone for joining us again. It's great to have you with us. I will apologize in advance. I have picked up a little bit of a cold on my way back from vacation last week, so if I annoyingly cough, I will do my best to cough as little as possible. So let's get rolling and talk about. Let's start just setting the stage with the market. So as we'll see in a minute, well, actually, as you can see, as you glance across the page, the third quarter was not quite as ebullient or not quite as strong as the rest of the year has been. Perhaps as different as different as the year has been as well. Pretty consistent performance across equity categories for the third quarter. You can see global equities down about 3.5%. U.S. equities, primarily defined by the S&P 500, down about 3%. Little more than 3, just shy of that same number. Small caps in the U.S. were down more, and I'll talk more about that in a minute. And even the differences between styles not so defined in the third quarter versus the 6 to 9 months prior to that. And we've saw it both in the U.S. as well as outside the U.S. So there's really if you will, a coordinated effort amongst market participants to step away from equities. Really the only real challenging number for the quarter relative to any of these negative returns was within U.S. small cap growth, where more speculative names did underperform through the third quarter, more so than say some of the other categories. We did see, as inflation's come down and rates have gone up, we have also continued to see volatility in both our real asset allocations as well as in long-term fixed income. The REITs and infrastructure, you can see both of those down 8-ish% for the quarterly period. As interest rates rise, and interest rates did go up quite a bit in the third quarter, REITs and infrastructure can be used by some, or periodically used by some, as either fixed income surrogates, because they tend to pay pretty healthy dividends and income distributions, as well as they have a fair amount of leverage involved in their business models, and as interest rates go up, that can have an impact on it. So it's perhaps not surprising to see a little bit of that impact at those levels during the quarter. At the same time, we did see the price of oil re-accelerate over the third quarter, and that definitely had a bounce impact on natural resource equities as well as commodities, both of which have somewhat struggled here through 2023, in line, if you will, with the changing consensus over time. We're going to talk about this in a minute, of whether we're going to see recession or not, what that impact might mean to demand for commodities like oil. Rates did go up quite a bit, and so you can see long-term treasuries had a pretty meaningful loss of the quarter. Fortunately, we have very little exposure there. We are mostly exposed across the FFTC portfolios in the U.S. aggregate type mandates. And so gave up a little more than 3% during the quarter as rates did rise. We've seen just in the last several days, rates have come down a bit again. And so there's a decent amount of volatility in the short term, the day-to-day basis across fixed income. We are, as we'll see in a few minutes, we continue to be shorter duration in many of our long-term portfolios, and that has definitely helped relative performance in the near term. Perhaps interestingly, and a disconnect from the equity markets is down here with these higher yielding loans or less or lower quality loans, which actually held up really pretty nicely, even in the face of an equity market sell-off. So lots of cross currents within the markets. And when we extend that out and look at it year to date, we see global equities up about 10% year to date. That is driven almost entirely by this US growth number. And you've seen it, and we'll see it here in this slide, excuse me, in a second, this notion of the Magnificent Seven or the Super Seven, or however you want to characterize those top 7 names, the NVIDIAs, the Amazons, the Microsofts, the worlds, those stocks are up a lot. Those are generally accepted to be quite good companies, right? Solid balance sheets, very good businesses, but they have gotten quite a bit expensive, but they have driven most of the return on a year-to-date basis. You can just see they are the top, basically 10 names in the S&P 500, which is this U.S. equity line. You can see the spread between large caps and small caps year to date is pretty healthy, and that suggests the market is pricing in outside of those 7 names some expectations for slowdown, and that's causing some impacts. We'll talk more about that in just a second. Sorry, let me go back real quick. Just touch on. I forgot where my circles ended. You can see, by and large, some of those categories I talked about that we own to diversify the real assets down a bit year to date. You know, those strong returns in the quarter help flatten out natural resource equities, of which we have a small allocation in the long-term pools. That diversification has been rather helpful. It is, you know, certainly here in the quarter and over the course of the year. In 2022, these positions were quite helpful as the market, you know, as these broader market pieces sold off. And then even with the give back in aggregate bonds, you know, fortunately, only down about 1% in our core bond positions from an index level. So that feels really pretty good. The upside, if you will, to taking losses in bonds as your forward-looking return starts to go up, because we actually have now some yield in fixed income that we really didn't have for a decade. And so now with a yield on this aggregate bond index, you know, close to 5.5, maybe 6%, depending on the makeup, you know, that we think sets the stage for much stronger performance looking forward. So I noted this notion of the Super 7. You can see it here on the left-hand side. And you know, the blue line is the cumulative performance for these 7 stocks calendar year to date. And the purple line is the performance of the other 493 stocks. And so you can see this pretty meaningful difference. The Super 7 collectively are up about 86% year to date. The bottom are only up about 3.5%, which leaves the S&P 500 up 13%. In those kinds of environments when markets are very narrow in terms of market leadership, it can be very difficult to perform on an active basis. And we had some challenges from performance. It's not very often you can say you're okay with underperformance, because you never like to underperform. But in an environment like this, we would absolutely expect to underperform. Not hopefully for very long, and we're starting to see that turn here in the back half of the year. But in an environment like this, where the only way to outperform is to be overweight these 7 names, that's just generally an environment where you're going to see a little bit more weakness in active management. You can see, though, by the slope of this line that the speculative view of the market in general, and we're just looking at those 7 stocks, but even if you drew a line that was somewhat similar in the small cap space or in the small cap growth space, a fair amount of speculation or focus on maybe perhaps the highest growing, highest opportunity stocks in the first part of the year. But you can see these have flattened out on a year-to-date basis pretty meaningfully since the end of June. And so we are starting to see the market start to rotate. And not so much see the small caps, or as example, do a whole lot better, but the leadership down in the short term is a little bit more leadership here up in the top. And then we show the individual performance for each of the stocks, and you can see, not all of the Super 7 are created equal, but these are pretty amazing returns for a very short-term period. When we look at broader economics, so Natalie and I were chatting about this before, this notion of where exactly are we? Should we be excited? Should we be pessimistic? What exactly should we be thinking about the world? Part of I mentioned before these cross currents, one of the major cross currents in the markets today is that there is no, while there are consensus views, the range of expectations around economic growth is significant. And there are, I submit myself to Twitter a couple of times a day, and there's it's almost guaranteed that I will see somebody that say that we're in a recession now. But we don't believe we're in a recession now. Lots of folks you can see on this slide, on this page in the upper left-hand corner, you can see that these lines represent consensus expectations for economic growth for 2023 at each given point in time. So you can see it was pretty dire in the back half of 2022 coming into 2023 in terms of expectations for 2023 growth. But as the market, as the economy basically said, nope, we're not going to give you that recession, expectations continue to evolve. And we just had a really pretty good economic print here more recently, but the expectation is that growth will slow. We aren't necessarily calling for a recession, and even if there is a recession, we're not going to be able to tell you what exactly it is. It seems very likely that with rates higher, meaningfully higher than they were 12 and 24 and 36 months ago, that the economy would slow. That's the point. That's the objective of raising interest rates, is to try to slow the economy. And it's really, we try to slow the economy because inflation is destructive to capital over time. You can see in this chart, this is a rolling 12-month inflation, CPI being the blue, which is the headline, core CPI being the green. And you can see the trend is in the right direction. There's as many different views as there are on economic growth, there are views on inflation. And I think while the general view is that, the consensus view, I think at this point that we can get back to this 2% target that the Fed lays out. I do think there are some potential challenges to that in the intermediate term. I think it will be something to definitely continue to watch. But because the inflation rate has come down, the Fed's been able to pause. They came out and they paused yesterday while leaving the door open to move higher on rates. You've seen this chart from us before, but just as a reminder, this is the Treasury yield curve. So this is yield on the left and maturity on the bottom. And back at the end of 2021, rates were significantly lower and the curve was more normally aspirated up and to the right. So typically this yield curve is positively sloped. And as you can see, it has gotten flatter than earlier points of the year, but we're still marginally inverted here from the short end of the curve. Short rates remain at that 525 to 550 level, but we've seen the 10-year Treasury come up and sniff 5% here over the last couple of weeks. Now, this morning, as a result of perhaps optimism around yesterday's Fed announcement, we saw the 10-year drop back down to the high 1060s, and I'm not sure where it's sitting today, but that's a good example of how much volatility there is within the fixed income markets and how much change in view really contributes to that volatility in the short term. So how did that impact our portfolios overall? So, as I mentioned, it was difficult quarter, just negative, just from an absolute return basis. And we had mixed results, I think, by and large, equity-wise. So the U.S. equity portfolio, basically in line with the Russell 3000 index for the quarter, which I think is, I'm happy with that result. In a down market, if we can hold capital or do a little bit better, we think that's good. We have gotten really pretty solid near-term performance impact from the components. So as you may know or you may not know, that strategy is made up of 4 underlying strategies. The core of that is a passive S&P 500 component. We have 2 small mid-cap managers that we hold at about the market weight, and then we have a low volatility component of that portfolio, investing in lower volatility U.S. equities. And the combination of that strategy tends to do better when markets underperform, and it will tend to underperform when markets really rocket. So In that period where I talked about where the first 6 months of the year were a bit more speculative, that is not a period when we would expect to perform well. And you can see the U.S. equity portfolio is a bit behind over that period. If the year finishes as it's going right now, then we're in much better shape to get back towards our benchmark by the end of the calendar year. As the more, if you will, the more diversifying components of our portfolio start to work. Non-U.S. equity, really strong performance, both from our core manager as well from our value manager. The value style has continued to outperform outside the U.S. Our core manager has the ability to move around in terms of their quantitative positioning, and as a result, really strong excess return out of the non-U.S. equity portfolio for both the quarter and the calendar year to date. Went through about a 12 or 15-month period where that strategy underperformed, and we would expect that to happen periodically, but really happy to see that back above board. Emerging market portfolio underperformed for the quarter. That's been a much tougher place for us, somewhat narrow market leadership in terms of securities that are performing. We continue to evaluate that structure and make sure that we have the right piece. And then global opportunities, which I can't recall if we mentioned this last time, but we are exiting this position from the diversified long-term growth portfolio. While we like the basic premise behind the strategy, it has struggled to deliver, and so we are exiting that portfolio within DLTG, and it did have a bit of a struggle. While our components of in real assets, while the top two, the listed infrastructure and real estate, were negative, as I noted, the active strategy there, which is Lazard, continues to perform extraordinarily well for the long-term portfolios where it is invested. It's a small allocation, but it is super helpful to have because it does tend to act just a little bit differently than the other equities in the portfolio. And so we need good active management there. And then you can see owning some of those natural resource stocks, which give us also some improved correlation relative to the rest of the portfolio. Pretty happy with this design and with that structure. When we look at the lower risk parts of the portfolio, I feel really good about what we've got going on here and anticipate no changes in the short term. As we often do, or as we always do, we start with a hedge fund portfolio. And for those of you in diversified long-term growth, this is a strategy that we own alongside fixed income as a lower risk portion of the portfolio. We want to get a better than bond return over time. We want to have bond-like volatility, and we want to have good diversifying effect. And this year and last year particularly, I mean, we've been happy with performance since the inception of this portfolio, but clearly over the last 18 months to 24 months, the strategy has added significant amount of value as a diversifier within DLTG versus traditional fixed income. Even though rates have gone up, we have not changed our view on hedge funds' role in your portfolio. And so we continue to, we maintain the view that we want to continue to hold them at the level that we hold them today, which is 15% of assets. But really happy with the way that combination, that multi-manager combination portfolio is working. While the absolute returns are a little less ebullient, the relative returns are still, I think, well within positive range for the fixed income portfolios. The core fixed income portfolio is in all of our long-term pools, as well as it's 40% of income and growth. And you can see, while a difficult quarter, still a small amount of premium, and on a calendar year-to-date basis, about 100 basis points. So we're still pretty happy, with the two managers that we have in there. This is a core plus strategy, so it owns mostly broad investment grade, but it owns a little bit of high yield. It owns a little bit of emerging market debt. So it does give us a little bit more return potential for a little bit higher risk, but we do very much like that construction and think that can continue to add value. I mentioned before, and we mention each time, the low duration component. So this is a position, as you'll recall, Sterling is the single manager within your low duration fixed income donor option. And it also is a component of each of our longer term portfolios that we have. If you will, we have a duration bet on inside of those longer term pools. And just looking at the relative performance year to date, clearly we're happy with Sterling's outperformance. There's a little bit less opportunity for spread here, but just having this portion of the portfolio react positively when the core of our core fixed income has been brought down by that rising rate environment, that position remains very strong. I'll continue to evaluate that today. We trimmed the hedge fund portfolio earlier this year to trim down within the DLTG model to make sure that our return-seeking assets and our risk-reducing assets were in the right balance. And we look at that periodically to see where we need to do that. Right now, portfolios are pretty close to target, perhaps a bit underweight in equity, within 1 or 2 percentage points for the most part. Last time I looked, which was actually just today. I ran through the portfolios today. So we're pretty close to targets overall. We would anticipate holding this sterling position for a while longer, but I think it is get closer to the period of time when we'll likely start to pull this short duration fixed income portion off, and we'll redeploy those assets most likely up into the fixed income portfolio just to get back to our long-term duration target, having been paid really pretty nicely here over the last 2.5 years of having that lower duration position. And then sorry, I'll just go back here just real quickly. The cash environment, one of the things that helps to support this is with that overnight rate of 5.25 to 5.5. That means money market yields are really pretty good. And whereas for a really long time they weren't. And so there is a little bit of cash in long-term pools, as well as this supports your lowest risk option. And you can see in an environment where there's been a fair amount of dispersion and return across asset classes, this has continued to do its job. So when we roll that all together, how the portfolios shake out, I noted the liquid reserves portfolio up a little better than 3.5%. It's adding value versus the T-bill market environment. So we're, the question of should we put more in cash or should we be trying to trade into cash? I think that's very difficult. You won't see us trading portfolios a lot in the short term, particularly trying to guess where equities are going to go or where rates are going to go, or trying, load up on cash because we think something bad's going to happen. We think that is an extraordinarily difficult thing to do. And those few that are good at it receive appropriate compensation for that. They're paid very well because it's just a very rare skill. Because we don't believe we have that skill, we don't want to burn up value for you by trying to trade around the portfolio a lot. We design these long-term portfolios to be able to deliver results consistent with each time horizon that should go with it, or each risk profile. So, if there's sensitivity to losses or sensitivity to a lot of variability, then the top half of this list is probably the right fishing grounds. If you really want to seek a return that can help you raise the probability of outperforming inflation over the long term and retain the purchasing power, the gifting power of your assets, then the bottom half of the list here is much more appropriate. And importantly, to get longer term returns, you have to take risk, and that means sometimes when the portfolio loses some money, and that's built into the concept of how we build the portfolios to live through a variety of different environments. And if all goes well, we will lop off the bottom parts. If you think about, returns over time as a sine wave, we're going to lop off the bottom parts. And by hopefully lopping off the worst part, but by lopping off the worst parts, we're probably going to give up some of the best parts to the top. But more often than not, if we can keep digging a big hole, then we don't have to fill it back in before we can move forward. So I think that's an important reminder as we think about performance this year. As we think about these more moderate allocations, you can see again we're happy with the relative returns that we're getting in the short term, and the year to date for income and growth, just about in line with its benchmark. When we look at active long-term growth, not only versus its specific policy indexes, it had a good quarter, but I think its basic structure is very similar to the passive long-term growth, and so essentially in line calendar year to date. In an environment where it's been difficult to drive year to date active premium, we're pretty happy with that. We're pretty excited to see this continue to be an appropriate option, and some of the active management and additional diversification that comes out of active long-term growth did help contribute to relatively better performance and holding capital relatively better in the quarter. The ESG pool has had a strong calendar year-to-date basis. The ESG pool, given its objective and its nature, does have a bit more of a growth bias, and so it has performed since growth has, as I talked about before, growth has led the way over the course of the year. It's performed a little bit better on an absolute basis than the other long-term pools. But you can see that as these styles come in and out of favor, it also on the quarterly basis did underperform a little bit, both on a relative basis as well as relative to the other portfolios. And then finally, diversified long-term growth. Again, this is that notion of lopping off those downsides, trying to protect capital when the markets are down more. I think DLTG's returns this quarter are actually a pretty good example of that. Whereas ALTG, which is all public, was down about 3%. The diversifying notions of hedge funds as well as some of the private capital help the portfolio hold up a bit better. On a calendar year-to-date basis, you can see that active long-term growth is outperforming, and it should have, because it's been on a calendar year-to-date basis still through September, still really pretty strong and ebullient upside returns for equity markets. And the more equity you have in that environment, or more public equity you have in that environment, the better your performance should be overall. So we have some underlying manager things that we're looking at the portfolio. We'll be evaluating probably. We have some manager rating changes amongst our research team, so we'll be evaluating those. Nothing that we need to do tomorrow. We continue to look at the margin and see if there are places where we should lean in, if there's a sentiment or valuation opportunity. But by and large, we're going to stay pretty close to targets overall, and really try and drive most of the value, both through the long-term strategic view as well as through manager implementation. So that is the extent of my prepared remarks. I will pause there and see if there's any questions, and maybe I'll take down the presentation so you can see us.
Thanks, Travis. All right, don't be shy, those attending. Put your questions in the Q&A box. It's the Q&A button at the bottom of the screen. Don't worry, only myself and Travis can see the questions, so I'll wait just a moment for everyone. I'll ask you a question first as we wait. Okay. Travis, I know you mentioned the Super 7 or Magnificent 7, so most of the year that's the story. Actually, almost all the year that's the story. And we looked at how the S&P 500 outside of those have done, which is really not all that great. But how has generally our portfolios done outside of the Super 7? How are you happy with it?
Great question. I think by and large, in the back half of the year, as the markets broadened out a bit, really pretty happy with the participation that we're getting. When I looked at our small mid managers through September and then again through October. I've just got the October numbers today, and so I'm starting to take a look at those. But when I look at those, I think about the notion that in January and February in particular, there was a very strong upside in speculative stocks across the board, and it was a little bit mind blowing to see how strong some of these small speculative companies were doing in the marketplace, and that dug a little bit of a hole for our active small mid managers, because both of our active small mid managers are going to tend to own quality. They're going to have a bias towards quality, so they're not going to do as well when you have a big speculative runoff. As that has peaked and rolled over, and in some ways significantly rolled over, they have begun to catch up. They haven't closed the gap the full way. But again, back to this notion of, you don't like to feel good about it at performance, but when you understand what's driving market dynamics and it's consistent with what you've built and what you should expect, then we can live with that. And so when I look at our U.S. equity strategy, we continue to evaluate each of the components, not just the active small mid, but do we have the mix right, and the ongoing role of lower volatility equity as a sort of a downside protection tool. We clearly like it right now because it is certainly helping, definitely continuing here through October. But it does cause some upside lag, and so we're continuing to challenge that, but we're happy to own it right now. Same thing within our non-US equity. We have the flexibility within our core quantitative strategy to move around relative to factor leadership. They've been extraordinarily good at that, and as a result, that's helped drive the performance for that portfolio right back well ahead of its benchmark. And when that works, and you get a period when the top of the market rolls over or rolls off, that low volatility component within the non-US strategy also works well. Emerging markets, we continue to work closely on. I mean, we like the underlying managers. Clearly, performance year to date is not what we'd like to see it. And so we continue to look at the mix. The quality of the managers we continue to think is great. And we don't have any large exposures anywhere. We have a small dedicated China allocation, but we're basically market weight in China today. So we continue to look at that because it's been a tougher spot for us to get right. I mentioned a little bit about our fixed income. We're happy with both of those managers, as well as with Sterling in your low duration. So we don't feel like anything is necessarily broken, but we want to generate and deliver the best results for you and generate those in excess of which we could otherwise get passively. So we continue to think about those things. And we didn't talk a lot about the private capital returns, but clearly private capital, because it prices slower than stock prices that we get every day or bond prices, it does introduce some lower volatility in the actual experience of an investor. And that can be valuable, particularly in a period like today, where equity market returns are down and bond market returns are down, and yet your overall portfolio doesn't go down quite as much. And does that mean it will never go down? No, but it means maybe you'll get those updates in prices, they come about with about a quarter lag. And if nothing else, hopefully that lower volatility allows you to remain comfortable with your long-term plan, which, it's hard to quantify, but I think that's a valuable component of the overall portfolio, of an overall portfolio design, particularly of DLTG.
Thanks, Travis. So I'm gonna ask you a question that I get in a lot of my meetings, and I have a way of answering it, but might as well do it on this call with more of an audience. I get a question, especially over the last few months, we've had, as you mentioned, negative returns in equities and bonds. And really, I lost $50,000 in my funds. I'm very irritated. What are you doing defensively? What are you doing to make my money back? What are you doing to make adjustments? I'm throwing a bunch of stuff out there right now, and then I'll get to the question. What are you doing to be defensive? How can you fix this? I mean, all of the above. And, in your response to this, can you just talk about how we think about asset allocation? I think you've hit a lot on it, but can we just reiterate what the portfolio is meant to do over the long term, and just setting expectations, as well as understanding just our philosophy about where we're going on the short term, and what we expect over the long term in terms of our portfolio structure?
Sure. So let's take that in two parts. So the first part is probably the most important part is for each investing entity, whether it be an individual donor or maybe one of your agency clients, is determining what return are you trying to achieve over what time horizon, and with how much risk are you willing to get there, and having a good, robust conversation to make sure that the selection of the option that you're in aligns with those notions. If you want to make 9% over the next 3 years and you don't want to take any risk to get there, don't think that can happen, right? Those are inconsistent or incongruent features available in the marketplace to be able to deliver returns.
I like to call it unrealistic expectations.
That's a good way to put it.
The math doesn't work out.
The math doesn't work out. Now, does that mean 3 years from now, I won't be telling you that somebody, made 9%, they didn't take very much risk?
Could happen.
It could happen, right? But those kinds of things are very difficult to forecast over short periods of time. So it's extraordinarily important to make sure that the selection you've made aligns with your risk profile and with your time horizon, with your return expectations. If you plan to give the money away, or you have a project coming and you need it within 2 years, it should be in cash or low duration bonds, right? I am a bit of a purist on that. If you can't afford to lose the money, it shouldn't be taking risk. If you have an agency funding need, or you're a donor that wants to be able to really support the community over a long period of time and support it at the same level 20 years from now or 10 years from now as you're able to do today, then you got to take a certain amount of investment risk to generate returns in excess of inflation. So you can give away 4.25% of your asset value and have that dollar buy the same amount it can buy today. And there is no free lunch in investing. Some people will say asset allocations are free lunch. It is and it isn't. But the reality is if you want to make return, you have to going to take some risks, and risk means that over certain periods of time you can lose money. And as I mentioned before, there are not very many investors in the world that are very good and very consistent at moving around portfolios with lots of opportunity in the short term. We just don't think that skill is very common. And those that are very good at it charge a hefty premium to do so. And they should, because it's a rare skill that you should find. That if you can find it, you can be confident in it, you should be willing to pay for it, because it's just not a common thing. We try to address that in this notion of how do we know that markets are going to go up and going to go down. Fortunately, equity markets over 70 or 80 years of global history in stock markets, they tend to go up. But there are plenty of 10-year periods when they don't. And so how do we build a portfolio that can live through an environment that we can't identify perfectly in advance, that gives us a high probability, or at least a higher probability, of being able to deliver that return in excess of inflation to help you support your mission? And that's really what we seek to do within the longer term portfolios particularly. And when we look at, say, a diversified long-term growth versus an active long-term growth, diversified long-term growth takes some additional risks. It takes liquidity risk, so semi-liquidity in the terms of the hedge funds, actual illiquidity in terms of private equity and private real assets and private debt. But for taking that illiquidity risk and some of those enhanced business risks that go along with investing in private companies, we expect to generate more return. It won't be in a straight line. Same thing even with public equity markets. As I just mentioned, they tend to go up most of the time, but sometimes they go down. And just like my conversation on the economic forecast, everybody and their brother, basically at the beginning of 2023, said there would be a recession in 2023, and there has not been one, and not even maybe close, depending on how you measure it. So getting those short-term calls is hard. We want to remain focused on assets that over long periods of time can generate that return, and then we want to build in the appropriate amount of diversification to be able to live through the periods of time when equity markets sell off. I'll add to this, the bit that makes it more painful in the short term is that we're taking our medicine in some ways today after 10 or 20 years of free money. When the 10-year treasury, and this was probably no more than 3 years ago, Tim, you can test my memory, 10-year treasury had a yield of less than 1%. 10-year treasury today is almost 5%. 10-year treasury maybe should have never been less than 1%. That's just basically free money. No risk in putting leverage on deals. And so over a 12 or 15-month period, we basically took back 10 to 20 years of free money. That's uncommon and likely not repeatable looking forward. So whereas our fixed income, particularly in the traditional only models, where fixed income just didn't provide the protection that one would hope it would provide when equity markets sell off, or at least have income that's coming in and backfilling, because there was no income with less than 1% yield. There's really no income coming into the portfolio. Now that income is 4.5%, 5.5%. And now you'll have more opportunities for those protective portions to provide some protection when equity markets sell off. But I don't think that it's a thing that we can trade around actively and try and add a lot of alpha. We could do it and tell you that we're adding a lot of alpha, but we just don't believe that it's realistic to think that way, and we don't want to harm your returns without an edge. Did I capture everything there, Natalie, you were asking?
You did.
Okay, great.
I got a question that really relates from the audience, and it relates to just what you're talking about, but will we make adjustments to improve returns, or we have a call to discuss where we are and where we're trying to go? I would recommend, give myself a call or shoot me an email if you want to revisit what portfolio or which pool you are in, and where you are and where you want to go. Like you mentioned, Travis, um, there's different risks that whether you're a donor advised fund or an agency fund here, a nonprofit. Let's have a conversation around that. Your needs may have changed since the last time we spoke. So please reach out to myself or your relationship manager. My email is really available on the website. Always myself or my team have Stephen Berard here as well, who is on my team. So please reach out and let us know. We'll set up something we can discuss.
Okay. Any other questions?
I'll throw one out there, Travis. You kind of talked about the low interest rate environment of, free money after the great financial crisis. Can you maybe just touch on what does a 5% Fed funds look like for equity returns going forward, and how kind of higher interest rates and yields historically have kind of worked with equity market returns?
Good question. I'm going to give you a squishy answer because I haven't done that math. But I'll rely a bit on my 30 years in the business. When I got in the business right after college, the Fed had raised rates to 6.5%. The yield curve was positively sloping. And the back half of the 1990s happened when we had just phenomenal equity returns when the 10-year treasury was consistently 5% or north. So I think there is clearly a historical precedent that equity returns can be strong when rates are higher, with one potential caveat, or at least one risk factor that we do need to think about and take into consideration, at least for the next few years. And that is that the level of debt today versus when I graduated from college 31 years ago, is that we have a much higher level of indebtedness, both at the U.S. government level as well as just in the global environment at large. And so we should expect to see that if a public borrower or a company, whether they be public or private, borrowed with floating rate debt, and they were at a 5 or 6% interest rate 24 months ago, and today they're paying 10, not all businesses are going to survive that. And I think there's some of that being reflected perhaps in small cap indices today, where some of those companies are more indebted. They're going to need to roll their debt as it comes due, and it will be harder for them to either get the debt or to be able to get more equity so that they can reduce their overall leverage. So I think there is going to be some volatility and some potential pain on that. Fortunately, in the US, based on the data that we have, it's not just one massive wall of maturities. So in some ways, it could take some time to work out, and we don't know what the interest rate environment next year or the year following or the following that's going to look like. So it could improve or get better. But there's going to be, some of the historical return, or the return potential that we might have thought about previously likely goes away, right? And it just has to be corrected. And one of those features of 10 or 20 years of Fed activity is that we did lose some of this cleansing exercise. Nobody likes a forest fire, but it cleans it up so it's less risky going forward, right? And we've not had as many of those cycles here over the last several years where companies that maybe shouldn't make it have been able to make it because capital's been free. Those companies maybe don't make it. Maybe going forward they get restructured. Maybe they just go away, and that's going to be painful, and that's going to generate some bad returns. But it's also going to create opportunities throughout different parts of our portfolios for managers to be able to get out and take advantage of some of that distress, some of that change, some of that what capitalism probably ought to look like. Not to over philosophize.
Thank you. That's great.
Like there's no other questions out there.
Great.
Unless you want any last minute ones want to come in. Well, thank you, both Travis and Tim, for jumping on and sharing your insights on markets and performance. Thank you to participants. Again, this will be posted on our website under resources, and you can also reach out to me with any questions afterwards. My contact information is on the website as well under investments. thank you, everyone, and have a great rest of the day.
Thanks all. Take care.